Welcome to Walva Sandwire. Today we're talking about Haim Hilman's call to adopt China's infrastructure model. Okay, so let's jump right in. We're looking at this argument from Haim Hilman. He's the Kita State Executive Counselor for Industry, Investment, and Higher Education.
Right.
And his core point, really, is that Malaysia's kind of shooting itself in the foot. We're stalling our progress because we're too hung up on short-term financial returns for these massive infrastructure projects.
Yeah, it's a pretty fundamental challenge he's raising. Haim's basically pushing for a complete shift in thinking.
A paradigm shift.
Exactly. Stop seeing things like ports, major roads, maybe even high-speed rail as just costs that need to turn a profit right away. Instead, view them as, well, essential engines, things that are meant to speed up the whole national economy.
So the big question we need to unpack is this. Should that strategic value, the growth it sparks everywhere else, actually trump the project's own immediate balance sheet? Should Malaysia just ditch this profitability-first approach for the really big strategic stuff that might take, 20 years to really pay off in the broader sense?
Well, that profitability first idea, Haim calls it an illness almost.
An illness. Strong word.
Yeah, and he argues it stems from demanding that immediate financial payback.
And the result. What does that actually mean on the ground?
It means, I think, that potentially great projects just die on the vine.
Right.
Projects that could really reshape a whole economic region might not even get past the initial planning. Why? Because they can't guarantee they'll make back the ringgit invested within, say, 5 years.
That fear of the initial cost, the short-term debt maybe, it just outweighs the long-term national need.
Precisely. And what's interesting is how he then defines what infrastructure is.
Okay.
He's saying things like airports, key logistics roads, the national rail network. Their job isn't primarily to make a profit themselves.
Their job is. What then?
To facilitate. They're economic catalysts. So if you judge them only by narrow metrics, like how much money they collect in tolls or ticket sales right away, you completely miss the often much larger economic benefit they bring to every business, every factory, every town they connect.
And this is where he points to China, right? The high-speed rail example.
Yes, that's his key international reference point. Now, it's pretty well known that large parts of that network don't actually make an operational profit.
Right. They lose money on paper.
But Haim's point is that the ticket revenue itself is almost irrelevant. It's tiny compared to the systemic value.
Systemic value meaning?
Meaning the efficiency gains for the whole economy. I mean, some studies suggest that the connectivity boost from that rail network unlocked huge productivity gains in the connected regions.
Like actual measurable gains.
Yeah, numbers like equivalent to maybe 1.7% of GDP uplift in those areas within just 5 years.
Yeah.
That's new economic activity, new jobs, goods, and people moving faster.
That completely dwarfs the operating loss on the train tickets.
Exactly. That's the fundamental difference in perspective he's advocating for.
Right.
Are you looking at the project's P&L or the GDP growth of the whole area it serves?
So for you listening, maybe think about a bottleneck near you, a jammed highway, an airport that's too small. Does the current way we fund things, demanding that specific road or airport pays for itself quickly through fees, does that really help your long-term economic chances? Haim says no, it actively limits them.
And that leads straight into his point about Malaysia's strategic deficit.
Strategic deficit.
Yeah, because we're always chasing these quick, easy-to-measure financial wins.
Right.
We end up lacking that bigger picture, that comprehensive medium to long-term economic strategy you need for real nation building. We're just optimizing for the next financial quarter, not the next generation.
It sounds like a trap, a cycle.
It is. It creates stagnation, he argues. We don't commit to the really foundational stuff, maybe expanding a port for future trade or building rail to link up less developed states because the 15-year payoff seems too long or too risky.
So by focusing only on those immediate ringgit returns, we actually stop ourselves from making the big leaps forward. We're stuck fixing today's problems instead of building tomorrow's network.
Okay, so if that's the philosophy, invest big upfront, even without immediate returns, then the obvious next question is, how do you pay for it?
Yeah.
Especially without blowing up the national budget right now.
Yeah, the funding question is crucial. And Haim has a specific suggestion here, acknowledging that the central government's finances are often tight. He says very clearly, the government must decisively open up private finance initiative, PFI models,
PFI. Okay, let's just quickly explain that. Essentially, it's where a private company handles the financing, building, and maybe operating of a public project, like a highway, maybe a hospital.
And the government pays them back over time.
Right. The public sector pays the private company a regular fee, often over a really long term, like 20 or 30 years.
So Haim sees PFI as the way to get things done, the key enabler.
It seems so. He frames it in terms of speed and efficiency. The logic is, if the government can't afford the huge upfront cost for something strategically vital, PFI gets it built now. The private sector takes the construction risk, handles the initial money.
So the project doesn't stall just because of budget constraints.
Exactly. Get the critical infrastructure in place fast. But, and this is a big but, PFI isn't a magic wand.
What's the catch?
Well, while it gets the debt off the government's immediate books, the public still ends up paying for it. And usually it costs more in the long run than if the government had borrowed directly.
More expensive overall.
Often, yes, because the private company needs its profit margin and their borrowing costs might be higher. So Haim's suggesting we shift the immediate financial burden, maybe get things built faster, but we don't eliminate the long-term cost. In fact, it could be higher.
That's the trade-off then. You swap immediate public debt pressure for potentially higher long-term costs and maybe less public control, right? Because the private company's running it for decades.
Precisely. And often, those long-term payments are locked in, which can limit future government's flexibility.
So for you listening, given we need these big projects, power grids, ports, whatever's relying more on PFI, accepting that long-term commitment and maybe higher cost, the only practical way to get them built quickly, like Haim suggests.
It's a tough calculation. And Haim isn't just talking theory. He's trying this in KEDA. He's championing this great KEDA economic body blueprint.
The KEDA plan. So that's his local test case for this infrastructure-first idea.
Seems like it. He presents it as a concrete, medium to long-term economic strategy for the state, not just, political promises.
And it's based on?
Well, the claim is it's modeled on successful international examples.
Huh?
Places that put infrastructure capacity ahead of immediate profit.
So grounding it in things that have actually worked elsewhere.
Yes. For instance, the plan likely pushes for better logistics roads, linking KEDA's industrial zones to ports, for example. And the key point is, they'd build that road even if the tolls collected in the first few years don't cover the building cost.
Because the real benefit is the economic activity it enables for those industries.
Exactly. The message is, if other regions globally have jump-started their economies by taking that initial financial hit for high-impact infrastructure, then Malaysia needs to consider doing the same, starting with plans like KEDA's.
So bringing it all together, Haim Hilman's core message is really a call for a fundamental change in mindset, isn't it?
Absolutely. A generational shift, perhaps. Move away from demanding immediate cash profit on these huge foundational projects.
And instead,
embrace their strategic value. Focus on the catalytic growth they unlock for the whole nation over the long haul, even if that means using tools like PFI more aggressively to just get things built efficiently.
Okay, so final thought here. If the real measure of success isn't the project's first-year profit, but the overall potential it unlocks, the regional growth, the faster movement of goods, the thousands of jobs, then what major Malaysian project do you think is stuck right now because it can't promise that quick 5-year profit? Which one would Haim say we should be funding and building like yesterday?
That's the provocative question, isn't it? Which critical piece of infrastructure currently seen as not viable financially would you push to the front of the queue using Haim Hilman's model? Something to think about.
Remember to like and subscribe for more videos like this.